Good morning, and welcome to our Asian Bond session of our Regional Investment Conference. I'm your moderator, Jason Pang. Our guest speaker today is Murray Collis. He's based in Singapore. He's our firm's Deputy CIO for Asia ex-Japan Fixed Income. Good morning, Murray. For the next 20 minutes, we'll be helping our audience connecting the dots between Asian bonds, sustainable income, as well as sustainable investing. The first topic I'd like to discuss about is negative yielding bonds. So Murray, from your perspective, what does negative yield bonds in developed bond markets mean for investors, and how does Asian bonds fit into this big picture?
Thank you, Jason, and good morning to everyone. And we think that negative yields in themselves on the global basis really point to the opportunity that we see within Asia. As Jason just mentioned, there's about $17 trillion worth of negative yields globally at the moment, and that's quite a significant rise, up almost 50% since the start of the year. If we think back to the start of 2021, the US Treasury yield was just below 2%. And as COVID started to emerge during late February and into March, we saw quite an aggressive rally in interest rates, not just in the US of about 100 basis points, but we also saw a broader rally across most markets globally, and particularly we saw rates rally in developed markets to yield lows. As we saw those yields rally, it was really a reflection of central banks globally cutting interest rates and really expanding their balance sheets to help try and support the global economies. And what we saw was governments also undertaking fiscal expansions really to try to support their economies. And I think that's a good opportunity really to bring up the first chart, which should show us really the state of play for yields globally at the moment. And so what we have here is the major global bond markets and their yield curves. So going across the top from left to right, we can see 1 years out to 30 years in terms of the yield curves, and down the left-hand side on the axis are the global economies, and we can see there that most of the developed markets in Germany, France, some of the majors like the United Kingdom are experiencing negative yields, and many are experiencing negative yields across their curve. Contrasting to that, we can see in the bottom part of the chart, really showing up very clearly in green, are the local sovereign bond markets here in Asia. So this is the likes of Singapore, Thailand, South Korea, China importantly, as well as India and Indonesia. And I think when we look across the markets here, there's very clearly opportunities in contrast to the low, close to zero yields that we see in the developed markets. If you look at a market like India or Indonesia, you're getting around 7%, 6 to 7% yield, and we think that's very attractive from a global perspective. If we extend that analysis and we start to think about markets, from a credit point of view in Asia, if we look at the JP Morgan Asian Credit Index, which measures credit in the US dollar market here in Asia, you're getting a yield also of just below 4%, so about 3.75% for an average investment grade market. And although we've seen a rally in spreads, they're currently just above 300 basis points, which is actually higher than the average over the last 10 years. We're actually seeing quite good value in those markets as well. So I think there's some interesting opportunities for investors when they look at Asia.
I'd like to move on to the next topic, sustainable investing, or some people call it ESG investing. I personally believe this was somewhat overshadowed by COVID-19 this year. But it really turns out that 2020 was a phenomenal year for ESG investing. Looking at Morningstar data, the AUM of ESG funds has crossed the 1 trillion mark. So Murray, what's your take on this, and what are the opportunities you and your team is seeing on the ground?
And certainly when we look at things, issues across ESG, certainly it's always been easy historically to talk about the risks that come, particularly around issues such as governance. It's always been a really important factor to consider, particularly in the high yield universe in Asia. But we are, as I said before, I think we're starting to see more engagement on issues like environmental, things such as climate change. We're seeing more green bonds being issued. And we're also starting to see social issues coming to the fore. And 2021, as you mentioned, COVID might have disrupted the development of ESG investing, but it hasn't actually. We've seen a really large increase in the number of social bonds being issued into the market. So, I think that's a nice segue into bringing up our next chart. And so, what we've done here is we've brought up the JP Morgan Asian Credit Index, which I mentioned before, which is, a broad measure of the market here in Asia. And what we've done is compare it to a newly created JP Morgan ESG Asia Credit Index. So what they did was they took away the existing index and they reweighted it on the basis of ESG factors from using data from third-party providers. They excluded some sectors such as thermal coal. But what you can see, if you look at the left-hand side of this chart, is that really over the last 8 years with the historical track record that JP Morgan's produced, there's no difference at all from a historical perspective. And when we first started talking about ESG in Asia, going back over the last 10 years, a lot of clients asked us, and it was a relevant question, what did it cost us for considering ESG factors? And what we've found from a historical basis, looking at this study and studies done in other markets, is that there's very little to no difference in terms of the cost. But actually, over recent times, and certainly over the last year, that we're starting to see more opportunities. And when we start to think about some of the regulations that can be coming through, some of the changes in the structures of the markets, the drivers of returns, investment returns in Asia over the past decade might not necessarily be the drivers in the coming decade. So, we think that there's some exciting opportunities to invest in the market. On the right-hand side is an interesting chart, and it shows you the carbon intensity of the JACI index, as well as the carbon intensity of the newly created JP Morgan ESG Asia Credit Index. It's no surprise, given that Asia accounts for almost 50% or over 50% of carbon released globally, that we have manufacturers in our index, and ultimately that means that the index has a relatively large carbon footprint. And so this is the intensity of the corporate issuers. It's tons of CO2 equivalent over $1 million worth of revenue, and you can see that the JP Morgan Asian Credit Index actually has a relatively high carbon intensity. So by reweighting your portfolio and considering ESG and particularly environmental issues, you can see that the carbon intensity of your portfolio declines by 50%. So, a very strong and positive outcome by looking at it from this point of view. And if you combine that with, just glancing over to the left-hand side, you're actually not giving up anything from a historical basis for doing that, which is very interesting. Recently we launched a strategy, a thematic strategy based on sustainable investing, because we do believe that it's an opportunity, and we want to present our clients, with the tools to be able to take advantage of that in the coming years. And on the right-hand side of that chart, you can see the carbon intensity of that particular strategy. So again, by giving a focus on ESG issues, and particularly a focus on themes such as climate change, you can achieve a strong reduction in terms of carbon intensity of the portfolio and still look to take advantage of the opportunities. When I think about some of the opportunities that have come up this year, one of the examples that we like to talk to clients about is the divergence in terms of the performance between a traditional high yield sector in Asia being Indonesian coal, and that of a relatively new sector in Asia being the Indian renewable utility sector. So for roughly the same rating, in terms of the same maturity, both in the high yield markets and roughly the same coupon, the Indian renewable energy space has actually really strongly performed relative to the Indian coal sector. Another example is in China, we're actually starting to see quite a large number of Chinese property firms coming and issuing green bonds to the market. And we think that, again, that's a really nice development that will help to provide enhanced opportunities for portfolios in the coming years.
So moving on to China, China is a significant component of the Asian bond universe, both in the local and hard currency space. This year, FTSE Weighby announced will be including China onshore bonds into the index starting from 2021. So this is the last of the three major bond index after Bloomberg Barclays, after JP Morgan. So Murray, what do you think is next for China bonds? What are the opportunities your team is seeing on the ground?
I think the FTSE inclusion is a continued development of what we've been seeing in China in recent years. And now with the three major bond indices, have China inclusion. But we really see this as merely just the start of the development, for China in the China bond market. The inclusion is the end result of more than a decade of developments to bring the onshore market up to the standard that we expect to see in the international markets. This has included improvements in secondary bond market liquidity, enhancements to foreign exchange market structure, as well as the development of global settlement and custody arrangements. These developments, have been really key. But I think it's important to remember that the client's exposure to the China bond market is still relatively low by global standards. We're talking, around 3%, which is much lower than what we would expect to see for a global or a developed market. And our view is that we would expect to see clients' exposure to China and the Chinese onshore bond market to rise towards 10% over time. But we have to remember that China's quite a large bond market. It's over 14 trillion US, and really to get to that type of 10% number is quite a significant amount of investment that needs to happen over the next 3 to 5 years. And so we think that that's really going to be a structural support from the bond market, but also the currency as we start to see clients or continue to see clients looking to take advantage of what's available onshore in China. And I think that's probably a good opportunity really to bring up the next chart onto the screen. So this is IMF data, and I don't think it should necessarily be a surprise to many of our viewers that China accounts for the largest amount of world trade flow in terms of this chart at just over 12%. And on the right-hand side is really what I was speaking to just before, which is the underrepresentation of China in terms of portfolio holdings globally. And what we've chosen here is actually the official foreign reserve currency composition from the second quarter of 2020. And so you can see, even from this viewpoint, that China represents only 2% of that particular data. And so there's really we feel a fantastic opportunity for clients to look towards China and to try to take advantage of that opportunity and the structural support that will come from reweighting of portfolios over time. If we look at the currency market in China year to date, the CNH and the CNY, they've rallied by just over 6%, and that makes China one of the best performing currency markets, in the region. And from the lows of March of this year, really over the second half of this year, we saw almost a 10% rally in the Chinese currency. So when we look forward to 2021, we're not really expecting to see the same type of aggressive rally of what we've seen so far in 2020, and particularly during the second half of this year. We expect the currency to continue to appreciate over the medium term, but I think the pace of that appreciation will moderate somewhat to next year. But it's important, I think, to consider that the structural elements of what has helped support that, not just the inflows, but also the handling of COVID, China and I think Asia in general has done fairly well if you think of it more broadly in terms of the handling of COVID. And China, in terms of the economy, has opened up. Certainly we saw the retail numbers yesterday relatively positive, and those types of structural supports will continue to next year. If we think back to the first slide with China, China's onshore bond yields and the sovereign yields at 3.2%, with inflation starting to roll over and fall a little bit, we're talking about a real yield of around 2%. And we think that provides, in conjunction with the currency, a really good opportunity for investors to be looking at in 2021.
Murray, thank you for your insights, to the Asian bond market as well as sustainable investing. To everyone who's joined us online today, we thank you for your participation. We hope to see you soon.